Every real-world asset protocol is like this bridge, impressive from a distance, but held up by hidden stress points. In this module, we'll surface those stress points, legal, technical, market, and governance risk, so you can design, analyze, or invest in RWAs with eyes wide open. Real-world asset risk in crypto travels through three connected layers. At the bottom is asset and performance risk, the actual loans, invoices, or projects that might pay late, underperform, or default. When cash flows here break, everything above comes under pressure. In the middle sits legal, regulatory, and enforcement risk, the entities, contracts, and jurisdictions that determine whether investors can actually enforce their claims. On top, you have smart contract and oracle risk, bugs, exploits, or bad data that can misroute funds or lock them entirely. In any RWA deal, you're never holding just DeFi risk or credit risk. You're holding all three stacked together. When we talk about risk in RWAs, the first question is brutally simple. Will the underlying activity actually produce the cash it's supposed to? Asset and performance risk lives entirely in the real world. Containers shipped, invoices paid, rent collected. Things go wrong through volatile cash flows, operational mistakes, or fraud, and counterparties changing their behavior when conditions change. If this bedrock is weak, no clever legal structure or on-chain design can fully fix it. Real-world cash flows are messy and unpredictable, so RWA structures try to tame that volatility with three layers of protection. First, underwriting and covenants act as a filter. Who can borrow, on what terms, with what ongoing checks? That reduces the chance of weak assets entering the pool. Second, structural defenses like junior tranches and overcollateralization absorb the first losses, so senior capital experiences smoother returns. Finally, incentive alignment keeps originators exposed to downside, motivating them to maintain asset quality and protect on-chain investors' yield. Legal and enforcement risk turns on one core question. If everything goes wrong, does the token actually give you enforceable rights? You can have assets performing perfectly, yet the bridge between the real world and the token still breaks. The jurisdiction might not recognize the token. Insolvency law might put a bank or senior creditor ahead of token holders. Corporate law might treat the SPV's equity owners as first in line. For RWA builders, many of the worst blowups come from here. Unclear token holder status, shaky legal wrappers, and untested bankruptcy outcomes. Enforcement friction is where DeFi expectations smash into TradFi reality. On-chain, everything moves in milliseconds. Collateral checks, liquidations, and cash flow routing. Token holders get used to that speed and start assuming enforcement on real-world assets works the same way. Off-chain, it doesn't. Recovering value means months or years of workouts, lawyers, courts, and manual servicing. That temporal mismatch is a core risk in RWA. Slow legal systems, cross-border complexity, weak servicer incentives, and fuzzy covenants all create drag that no smart contract can magically remove. Now let's move into the tech layer, where everything can break even if the real assets and legal structure are solid. Think of this as the cables in a suspension bridge. Smart contracts, keys, and cross-chain bridges. Bugs in code, leaked keys, or a failed bridge can instantly drain value. This is independent failure risk. Losses that come purely from infrastructure, not from how the underlying loans, invoices, or SPVs are performing. Oracle design is where RWA theory collides with messy reality. Off-chain, everything is fuzzy. A late payment, a lawsuit, a restructuring discussion. Lawyers argue, managers negotiate, documents update. On-chain, the protocol wants a clean yes or no, covenant breached or not. Compressing that nuance into a single Oracle feed creates a choke point. If the data source is wrong or manipulated, you get integrity risk. If it's slow, you get latency risk. And when situations are truly complex, no simple API call can capture what's really happening. Risk in RWA systems rarely shows up in isolation. A macro shock, like a sharp rise in interest rates, can hit play on a whole chain of problems. Asset performance weakens, SPVs face disputes, and technical systems are stressed at the very moment you most need clean data and smooth execution. Scenario coupling means stress in one area amplifies failures in others. Wrong-way risk is worse. The same event that hurts assets also breaks your protections. And because this is all procyclical, many things tend to go wrong at once. In most RWA structures, the people who can actually push the buttons are not the ones who eat the losses. Originators control the underlying assets and operations, but often use SPVs to cap how much downside they personally take. SPVs and trustees control the legal plumbing, yet they're typically paid fees, not bearing the main economic risk. Oracles control what data hits the chain, but rarely share in asset losses if that data is wrong. Meanwhile, DeFi token holders often have almost no operational control, yet absorb nearly all economic, legal, and tech risk when things go bad. Imagine you're a DeFi lender buying senior safe exposure to a pool of real-world loans. You think your risk is mostly about borrowers paying on time. In practice, you're often sitting directly under the heaviest blocks: legal enforcement risk across jurisdictions, and smart contract or oracle risk. At the same time, the originator's junior piece is tiny, so they don't lose much if things break. That misalignment between who controls what and who takes the hit is where many early RWA deals quietly went wrong. Think of resilient RWA design like constructing a building that can handle storms. The foundation is the originator or junior capital, taking first loss and proving alignment. Above that, senior DeFi lenders provide the main funding pillars. Sitting on top are the two big risk blocks: legal and enforcement risk and smart contract risk. To keep the structure standing, align risk with control, insist on radical transparency, use adaptive governance that can replace failing pieces, and design tokens so each risk clearly flows to specific holders.